Hello and welcome everyone. I'm Robert Baharian and this is Masters in Investing. They say life never stops teaching and we never stop learning. This show is my exploration with investors to both understand and unpack what is going on in markets right now and what this means for business and for investors. Please don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today is Andrew Papageorgiou, the Managing Director of Realm Investment House, a specialised fixed income manager based in Melbourne. During our conversation, we talk about what Andrew refers to as manias. We talk about the state of play of the property market currently and what that means as it feeds into the banking system, and also what that then means for investors. I also learned a new word today from Andrew, discombobulous. Listen in, find out what it means, and I hope you enjoy the conversation. Andrew Papageorgiou, welcome back to Masters in Investing. We're supposed to do this face-to-face live, but with the snap lockdowns, we're back to Zoom.
It's great to be here, Rob. Thanks for the invitation.
We spoke in November of 2020 in season 1 of Masters in Investing, and we were really in the thick of it back then. If you remember, COVID was, we're 7 months down or in from when we spoke last. And the title of that particular episode was called It's a Brand New World. Interest rates got cut down to where they are today, to historic lows. And the world, the markets, investment markets were rallying quite hard, but nobody believed them. Nobody believed the markets at that point in time. There were talks about second generation mutations of the virus. There were talks of double dip recessions and a whole bunch of things. Now we're in June of 2021 now, and we are certainly far from where we were at back in November of 2020. I'm curious to get your point of view, Andrew, if we can start with the key conversation I think most people are having now is cash rates and probably inflation. And I'm curious to understand from your perspective, with inflation breaking out most recently and the RBA coming out or a couple of days ago now, keeping rates on hold, what's your take on the commentary from the Reserve Bank and their current stance at the moment as it relates to the Australian economy?
Yeah, look, I think as far as the first part of your statement there of inflation breaking out, okay, so clearly the perspective of the Reserve Bank and most central banks for that matter is that the spike you're seeing in inflation currently is likely to be transitory. And when you actually look into the detail of what it relates to, the central bankers and economists are pointing to the fact that it's in areas that are unlikely to be enduring. Okay, so in the first instance, there is a pickup in inflation. It's in areas like your used cars and a range of other areas, travel, hotel in the US, for example. A range of areas where I think people could fairly suggest that perhaps it's not enduring and it's not enough to overwhelm the structural factors or the structural elements that have kept rates where they are or kept rates low or driven them lower over the period of the last 10 years. So whether it's technology or aging demographics and all the stuff we've talked about. And what you've got is essentially you've got a market wrestling with narratives. I think we spoke last time about the fact that at the end of the day, you're really betting on what the market thinks rather than any destination, because of course you never actually get to an end destination, right? The fact of the matter is there's just an arm wrestle of ideas, and at certain times certain ideas are in the ascendancy and markets respond accordingly, and in other cases the opposite occurs. And right now what you've got is you've come off a period in early 2021, in particular February, where I think in the first instance people started to potentially assign a greater probability that things weren't going to be benign forever, or rates weren't necessarily going to zero. So you saw a recalibration of the odds. And what that resulted in was a sell-off in rates, especially at the longer end, which a lot of clients would have noticed that in their portfolio. So interest rate duration had a really, really bad February, of course. Now, the reality is we find ourselves 3 months on, and I think a lot of people would look at rates, and especially the longer end of the yield curve, so 10-year rates, which is the part of the interest rate market that tends to be a bit more volatile, okay, because that's where markets show themselves the most. So a 10-year bond will magnify interest rate expectations over the long term. So right now, what you've got, interestingly enough, you've got a bond market that's actually been pretty well contained, and the yields are actually a fair bit lower than where they were in February. We're 30 or 40 points lower. In the case of the Aussie 10-year, we're about 30 points lower, I think. So clearly what you've got here is you've got a market that hasn't absolutely taken that idea of enduring and permanent inflation and run forward with it. You've still got a good portion of the market looking through and around the here and now. And, a lot of people are still to be convinced, I would say, that what you've seen from an inflationary standpoint is permanent. A lot of people would still feel that the bigger wheel exerts greater gravity. And by bigger wheel, I mean your longer term structural drivers. Technology is a big one. Demographics are big ones. And they are arguably more meaningful factors over the long term than
but aren't those
there being a shortage of used cars.
Aren't they more deflationary? Like if you talk about technology,
absolutely,
isn't that something that's more deflationary? So when you talk about this spike in inflation and the consensus might be coming to now the fact that this may not be as a longer issue than maybe what they had originally thought. Back in February, when rates started to rise and we saw huge sell-off, I think like a 20% plus decline in the 30-year US treasuries. That doesn't happen very often.
No,
and generally when you do see that happen, it starts to sort of snap back and it gives back or it regains some of those losses. What's different from then? I mean, it's only 3 months ago.
I'd caution that. That whole idea of reversion, where as human beings, we're wired to expect that reversion and that snap back because it's gone too far. It's gone too far in the context that there wasn't something structurally occurring underneath the surface. But, people that were around and traded bonds in 1994, they would tell you that you don't want to get too carried away with your own self-reference criterion there or with your own cognitive biases that it's going to snap back, because essentially if inflation were to become more enduring, well then, even Aussie 10-year bonds of 1.6, 1.7, wherever they are at the moment, that is arguably a rate which doesn't express the risks of inflation becoming more entrenched. So what I'm trying to get forward here is that you have to look at these things probabilistically. Picking interest rate markets is and you can ask those that have traded them the longest, is difficult. It's problematic. It's a really low quality decision because essentially there are just so many factors that you have to take into consideration. So, for example,
that's like with any market. Right?
Of course. But like bonds are one market where they're deceptive in their simplicity, because in that you've got one rate and one number, and you've got we're all we're assaulted with all this economic data all the time, right? But the reality is they are very, very difficult to pick. These markets are very difficult to pick. Even the guys that have done it the longest and who are the best at it find them very, very difficult to pick. And where they really hurt you is where your level of certainty is almost at its highest. Okay, because essentially where your bias takes over and you start to put aside a probability-based approach in terms of thinking, that's where you get really hurt. Okay, and what I mean by that is, looking at it from the assumption that that inflation is definitely going to become entrenched and that bonds are definitely going to rise. Well, if you had that view and you believe that very, very strongly, you're going to assign a very, very low probability, for example, that bond yields could rally materially. okay, you're going to assign a very, very low probability that rates could have a negative correlation with credit and other asset classes. So, equally, if you are absolutely certain that this deflationary spiral of technology and demographics and low rates creates a unavoidable vortex, what you're going to do is you're going to fundamentally underestimate the possibility that bonds could sell off. Okay, so this is where you get yourself in trouble with these markets. At the end of the day, none of us have perfect foresight. If we did, none of us would be here. You might be, I certainly wouldn't be, right? So essentially all we're doing is we're just dealing with probabilities, and what you've got to be looking at is you've got to be looking at, you've got to be looking at your bets and making sure that the weights are assigned to the level of uncertainty within a decision. And as far as rates are concerned, the reason I answer the question that way is that rates, the outlook for rates is a really, has historically been a really low quality decision. Okay, it's real low quality risk. It's a hard one to get right consistently. And that's, as such, there's not really a heck of a lot of value in making those bets. Okay, so, so from an economic perspective, look, it's balanced. I think you've got to recognize the fact that the gravitational factors are strong. I think the productivity gains of technology and, the fact that a lot of these tools and instruments that we're becoming more aware of and comfortable with on a daily basis reduce the need for labor, they reduce the need for travel, they reduce the need for office workers, they reduce the need for data entry. I look at our own spreadsheets at the moment where you've got guys that can essentially code for programs to go and grab data from websites and bring them in. So you don't need anyone downloading that. There's a job gone, right? So when you extrapolate that across the market and the economy in the context of an economy where everyone's getting older and birth rates are in decline, it's from that perspective, it's very difficult to see how over the longer term inflation is a problem. Equally, though, in the shorter term, it's fair to argue that the recalibration of supply chains, the disruption of coming out of the pandemic and perhaps the permanent destruction in some areas around capacity will have an inflationary impact. To what degree that's longer or shorter, that's the arm wrestling match at the moment. And look, I think at February, the inflation view or the sell-off in bonds, again, just to reiterate, I don't think that was necessarily the market saying inflation's definitely coming. I think. What do you think it was? Well, I think that's the market saying there's a possibility inflation's coming, because prior to that, rates were probably, overly betting on the idea that deflation was a fait accompli. So you could argue that actually gets balanced up a little bit more.
For such a long period of time, market commentators and experts were talking about how all of this quantitative easing and everything that central banks and governments around the world have thrown at financial markets, at local economies since the GFC, it's not working because it's not creating inflation. It's not working. It's not creating inflation. And it's a really good point you raised before about getting too confident about your own biases and your own ability to be able to predict the future. For such a long period of time, nothing happened. And it's literally almost overnight, not quite overnight, but in a very short space of time, that viewpoint changed. It took 10 plus years or however long it took, but it changed. And we saw the result of that in the valuation of treasuries and rates rising. And you mentioned before about, if we had complete foresight, we will be able to, we wouldn't be here. And I think the concept of applying probabilities is really, really important. I think it's underestimated, because if you and I were sitting 6 months or a year ago from today, and we were having a similar conversation, I wonder how many people actually think about the probability of, well, what if this virus and what if the markets don't respond in the way we expect? Because I know a lot of money managers who would position their portfolios in such a way that this is going to get worse. Oh, this is just a dead cat bounce. This is going to get worse. 1 year later, they're creamed. Markets have risen 60, 70, 80%, and they're sitting in cash. Now what? You're you're screwed, right?
Yeah. So look, I think modal bias, it's an easy mistake to make. it's a really easy mistake to make. So, if, it's a good discipline sometimes. So if you were to sit there and whether it's your outlook for the equity market or your outlook for rates, if, you had to assign probabilities around where you think the market is going to be by 100 point increments, and you started to assign those numbers, what you're going to end up with is you're going to end up with a distribution. Okay. And that distribution will give you a sense of how normal you think the outlook is. Now, if your distribution and your outlook looks log normal, in other words, if your thinking is skewed to one side of the trade, okay, the reality is that you're not conceptualizing the potential for the other side to occur.
Yeah.
Right. Now that as soon as you sort of see that, so if you look, I think the most effective decision makers from an investment perspective look at the world that way. That's the way they almost see it. Okay. So when you've got a view that's very log normal or is in kurtosis, in other words, you see the world coming out into a very thin range of outcomes, the risks you're likely to take at a portfolio level or within your investment portfolio are going to be very, very high, because you're making that mistake, what Donald Rumsfeld called the unknown unknowns. That's where you're just not putting enough points into or enough stock into the fact that you don't have perfect foresight.
Do you think enough investors ask the question, what if I'm wrong?
I think you do it long enough, and you get punched in the face enough times, and you get there. You come to religion your own way, right? Like you lose enough money at anything, and it'll give you that perspective. So you do this for long enough, you get there. When you're seeing, but interestingly, I think that's why those of us who are lucky enough to have grey hair, I'm not one of them. I've jumped straight to no hair. But those of us that are in this unfortunate position, that's why, when you do see mania in its many forms, whether it relates to, crypto, or whether it relates to, the fintech revolution or any other source of mania,
do you believe it's a mania, Andrew?
I believe that a good portion of price action in things like crypto are explainable by mania. I think, look, it's an interesting question when you look at the roots of it. Clearly, a lot of them started out as really good ideas that I think in terms of Bitcoin and alternative to money was almost the libertarian flag, right? Like the fact that fiat money was dead, and here's something that's reliable and it's closed and it's finite and blah blah blah. But for it to be able to replace money, it needs to be stable. When it's not stable, it's really hard to use as a medium of everyday exchange. And then, of course, it became a really effective way of facilitating the movement of goods and services, shall we say, on dark webs and black markets. And at least at that stage, you could say it had utility. It had a day job, right? And the higher the value went, you could argue the more money you could move on across borders on a memory stick. Now, without being an expert on such things, I would say there's probably a little bit of value in being able to move $1 billion in a memory stick across a border, right? So, when you start to actually close that line off, then the question is, well, how is the price explainable? And when you look at things like hits on the web and interest on the web and search statistics, and you track it. You track it with the price. There's a reasonable relationship there that can be inferred, from that perspective, it's probably got as much Pokemon Go in the price as it does gold, right? Like that's how I see it really simplistically. Yeah,
I don't disagree. Although a lot of people would have referred to stocks back in the 1920s as mania as well. Like 2% of the population were investing in stocks. It was a gambling house effectively, and people were speculating. That's how a lot of people became rich. That's how a lot of people lost money as well, following. But fast forward 90 years, here we are. It's a mainstream investment or asset class. We have huge numbers of populations now investing in it. But having said that, you've got something that you're actually investing in, something you can value. Is it stable? Not in the short term, but over the long term, yes.
I think you'll learn. I think we'll learn more about it, right? Like in terms of what are its correlations. Right now, it seems to have a pretty solid positive correlation to risk markets generally, right?
Yep.
And that's been the case. So, I mean, from that perspective, you know, I mean, VIX isn't real. VIX isn't something you can touch, but that's something that everyone's happy to trade. And, you know, so once it's there on futures markets and you can start to leverage in it and play with it, you know, ultimately it doesn't need to disappear. You know, but the fact of the matter is that I think, you know, right now, correlations seem to be pretty positive to underlying risk markets. And again, there seems to be a you know, a level of mania attached to it.
Yeah.
What it ends up fundamentally being, you know, does it end up being a store of value that society ends up accepting is commensurate to holding, you know, precious metals, for argument's sake,
Sure.
or other assets? Look, we don't know. We don't know. Those people that have made money out of it, it's a real skill. You know, it's not to denigrate their achievements or what they've been able to do, because, you know, in any market you operate in, being able to actually get what Dennis Denuto famously called the vibe and play with that vibe and make money off that vibe, it's a skill. It's a skill to understand fashion. It's a skill to understand trends. It's a skill to, you know, why is it that some of us know exactly when to pull out the corduroy pants because they're coming back in, while, you know, people like myself are still stuck wearing them 2 years after everyone stopped, right? You know, different horses for different courses, right? But, you know, it does actually, you know, it does impress me how that generation, because it is.
How do you think that's going to change investing, Andrew? Because there are many people around the world that have studied for many, many years, going to some of the finest schools around the world to learn and understand the finance and the intricacies and how it works and formulas and calculations. And then all of a sudden, there's people making millions and billions of dollars on things like meme stocks and cryptocurrencies and shit coins and all of these things. And you can do one of two things. You can slam your fist on the table and say, this is not how it's supposed to work, and we're being taken for a ride here. Or you start to learn and adapt. And I just don't know if they teach the vibe at school, Andrew.
No, I don't know if Dennis Denuto picked that up at law school, the vibe. Look, you've got to respect that these
I agree.
The kids have got a way of tapping in. There's a way where they engage and somehow wire themselves into a group think that's just you know, frankly, it's new, it's different.
But is that mania as well, as you refer to it, or is that something that too will pass?
Oh, no, I don't think that passes. I think they just understand the game in terms of how they communicate, and they understand, you know, there's almost a dog whistle among them, for want of a better word. But no, I don't think that changes. I think you see it equally in things like GameStop or this and that. I mean, what beats that out of you are losses. That's what beats that out of you, right? So, you know, this market in a lot of areas has a lot more of the 99 2000s about it than, you know, than the 07s, 08s, for argument's sake.
But how many people are actually making losses? Because markets, sure, they've had their little dips here and there, but largely, especially since this time last year, market's just gone up.
No, no one's made a loss yet, which is why, you know, everyone's still doing it, right? Like you need to take a loss to actually sit there and understand that there's two sides to a trade, right? That's the reality. So nothing has happened as yet to really force and drive a level of reevaluation of processes and beliefs. Okay, that said, leaving everything else aside, these guys are great at communicating through the various technology platforms and understanding each other and almost getting a real sense of where things are going. And look, they do it without accessing you know, the types of technology that, you know, the Facebook generation, which is what I'm in, access. So they don't watch TV. They don't, you know, they educate themselves from things like TikTok, for example. It's, you know, it's crazy. It's great. 30 seconds at a time, they can learn all about the French Revolution. I have discussions with my son, which are awe-inspiring to me, because you know, he comes to the table in his mind with.
How old is your son?
He's 13. So he in his mind, he comes with just as much heat as I have, where I might have watched endless shows on the History Channel and read a number of books. But you know what? You give him 5 expertly curated TikTok videos on a subject, and he will tell you everything you need to know.
It's pretty cool, though.
Yeah, it is. It's super cool. It's actually super cool. Where you worry is how the owners of these platforms use technology and use the selection of content to corral young minds and affect young minds. That's a real concern. And that might be the smoking of this generation. You don't know. I mean, who knows how this ends up working out. But, the reality is they're built different. That's what my son tells me all the time whenever I say, well done, he goes, Dad, I'm just built different, which means something apparently. So they're built different. I've got a 17-year-old daughter, again, the same type of thing. Like it's really impressive how they can get across stuff, how they can build an understanding on things, and how well wired into each other they are. So that's probably the one thing where you look at it and you go, well, that's a little bit different, and that probably feels like it could be a bit more durable. And look, I think a lot of businesses adapting to the fact that these guys are finding new ways to communicate, and communication channels and tools are changing. How that affects Bitcoin, I don't know. I think sooner or later, you're going to have a sell-off. I mean, we're not done. We're not done with normal market behaviors. We haven't seen the last sell-off. We haven't seen the last bit of market volatility. Sure, at a time like this, it's where economies are sort of bounced back, and the narrative is very much one of here in Australia, especially where we've basically reclaimed and we've recouped all the losses from COVID.
Yeah.
Until this latest Victorian knockdown takes a little bit of it back. But let's just assume we're still okay. It's really hard to sort of see what goes wrong from here that gives you a hit. But what we do know is something's out there, and equally, we don't know what the suppression of risk by central banks does either, but the fact is by managing every cyclical sell-off and by coming in and, bailing out the system on a almost biannual basis, you're in a position arguably where you're pushing forward an event that ends up being bigger.
We talked about that last time, where the Reserve Bank at the time were giving feedback to the market that things are going to be okay. We're not going to raise rates for the next 3 years, and keep things as business as usual, because we've got your back, and please continue to do business, lend money and borrow money and all those things. And here we are 6 months later. And now the questions being asked is the RBA going to turn on those commitments and start to raise rates? What's your point of view on that, and as it relates to cash rates and Australia? Well, what everyone's watching is to see if the term funding facility rolls over. So what they're doing at the moment is they're saying basically rates stay where they are for 3 years. Yeah. Then the question is, well, what happens post that 3-year period? And they actually make that decision every 6 months. They roll it forward. Right, so everyone now. Hold on, they roll the what forward? They roll that 3-year period. They've actually rolled it forward once before. So when we initially spoke, there was the 3-year block. Yep. And then as we're getting close to the next 3-year bond roll. Yes. Okay, what happens is they roll it to the next one. So right now there's a little bit of conjecture around what happens and whether at the next roll the RBA moves its 3-year interest rate guarantee, for want of a better term, to I think to the November 2024. Okay, or whether we actually see a situation where they say, okay, well, that's it from now on. After that period of time, you can expect rates will start to normalise. Now, if that happens, what you will see is you'll start to see the 3-year government bond increase in yield. So right now, your 3-year bond is meaning it'll sell off. Yeah, it'll start to sell off, okay, because it's no longer protected by the RBA. Yeah, if that makes sense, So then what happens is that starts to normalise, because people will start to work on the assumption that after that window closes, well, then what you might see is a reasonable spike in rates or a normalisation. So does that mean at the beginning of the year we have longer term rates selling off, and as time goes by, we'll start to see rates in midterm start selling off, and maybe in the shorter term eventually also start selling off? Well, what tends to happen when rates at the shorter end start selling off, you generally see a flattening
of the yield curve. So if we think this is your 1-year bond and this is your 10-year bond, so an upward sloping curve is indicative of an economy that has good health.
Sure.
It's expected to grow over the long term, and we're accepting that the very short-term rates, they're very low, and they're supporting the growth up here. And as rates in the short end start to rise, well, then this isn't so accommodative. So, you know, the difference between 1 and 10-year starts to flatten.
Sure.
If the view is that they overdo it here and they raise rates too much, you get an inverse yield curve, which is portends a recession, because now the feeling is that the loss of monetary accommodation is now going to push the economy towards recession. Okay, so you get a inverse yield curve, which is generally a sign of an impending recession, as I said. So in the first instance, what you would expect is the 3-year bond yield would go up. Okay, the 10-year bond yield doesn't necessarily need to go higher. It doesn't need to go lower either. It might just stay where it is for argument's sake. And then it develops from there. You know, the question is, of course, to what degree can Australian society absorb meaningful increases in interest rates from here? You know, everyone can make their own mind up, but if you get enough people to borrow 700,000 or 800,000 to buy a new home as a first home buyer at rates of 2, you might find they're not in a great position to be able to pay rates of 4. And, so you think about that, an interest rate of 4%, which isn't high, on a loan of 500,000 for 8.
But presumably it'll take a long time to get from 2 to 4. And you'd like to think, or I'd like to think people would start adjusting their own expectations and financial resources to accommodate for that.
Yeah, in a vacuum where people have resources and they can do that, that's great. But they don't. You know, this is the one thing. This is where you've got to be careful with soft reference criterion as well. At the end of the day, you know, $20,000 for after tax, okay, is it hurts.
Yeah,
it actually hurts. It really hurts. And then don't forget, you still got to pay your principal. This is the one thing. I mean, if it's a $500,000 loan, you've got 25 years to pay it off. You've still got to pay 20 grand a year in principal, and then you've got your interest as well.
Are you worried about this, Andrew?
No, not really, because I just don't. I don't think they're going to be able to increase rates like that. That's really where I get to with it. They're not going to cut their nose to spite their face.
Why? Why would they be cutting off their nose to spite their face?
Because essentially, what you've got is, look, just because interest rates don't provide a massive benefit when you cut them because they're so low already, you don't want to work on the assumption that it's not going to hurt when you raise them. Okay, because the level of household debt is actually, it's reasonably high. Okay, and what you've got with a lot of people, especially first-home buyers that are buying money for the first time, and they're buying rates, and anecdotally, a lot of these young people are taking loans of between 500,000 and 700,000. Right, they're a small portion as a part of the broader economy. Okay, because back books, the average loan to value ratios in back books is actually really low. So when you look at the number in the aggregate, it doesn't show. But when you actually look at it compositionally speaking, a lot of these people that you want to engage in household formation and make durable purchases of fridges, and you want them having kids, one for mum, one for dad, and maybe even one for the country. These people are carrying debt, right? They're carrying debt that if you did increase rates by 100 points, even 100 points or 200 points from where we are right now, and we're really, really low right now. And it's not just rates, right? Because BBSW is at 0, excess deposits through the roof. Banks are not needing to buy money. The wholesale funding markets are essentially closed. They are.
So can we talk about that? Because last time when we spoke in November, we had a conversation about banks. And at the time, people were quite worried. I think dividends were cut at the time or something like that. I can't remember exactly what was going on. But I distinctly remember you were saying that the banks are in pretty good shape, notwithstanding the headlines that people were reading and that commentators were putting out there, that you, dealing with the banks on a daily basis, were of the view that the banks were in pretty good shape.
Yeah, and they still are. Yeah.
Are they, well, a lot has changed since then for the positive. So are they in a much better shape? What's their situation now?
All the concern was around forbearance, was around the loan performance. That's where everyone was worried, right? And my comment at the time, I think without having perfect foresight, despite what I tell my wife when we're arguing, I think my view at the time was that the forbearance question wasn't wasn't something that had me particularly worried, because essentially we could see that the curing rates were reasonable. And I think right now the majors sort of find themselves with arrears. Look, they'll get to about 1.7 to 1.8%.
Is that high? So, I mean, it doesn't sound like a big number, but
it's high by historical standards, right? Because we're talking about the whole financial system. So, you know, if these guys have about $500 billion worth of loans each, that's $2 trillion, $2.5 trillion worth of loans. And 2 trillion, what's 2% of 2 trillion? 40 billion. It's a big number. It's still a big number, but they're not going to be losses, right? These are people that are in arrears. And most of them will recover out of arrears. But yeah, it's not a tiny number, but it's been well provisioned, right? So it's not that those numbers won't be creating losses within bank P&Ls. If anything, you've seen in the last reporting season, you know, they were right back. So there's no concern. So
it's not like the banks don't know about these numbers.
They're in the numbers. They're absolutely in the numbers. There's no issue there at all. Look, the bigger challenge for what we're talking about is we're talking about the ability to actually move that lever and increase rates, right? That's all I'm saying. I'm not saying I'm worried about the banks. I'm not worried about people going under. What I'm saying is that in my opinion, the delta of rate rises to economic activity will be really, really high. So basically, you know, not much interest rate activity, not much of an interest rate rise has the potential to affect activity quite meaningfully, and will likely drive the RBA to stop a normalization, or the normalization of rates sooner than maybe a lot of people think. And when you look at it from that perspective, and then you say, well, okay, well, what does that mean for the rate path? You know, the question then becomes, and this is instructive, people don't think about 10-year bonds being a, you know, decomposed rate path, right? Because just too far away, and there's there are too many other factors at play. But, you know, if you were to, the reality is that, you know, an interest rate of 1.5 to 2%, which also coincides with a normalization of funding markets. And what I mean by normalization of funding markets, right now, the banks have hundreds of billions of excess deposits. They've got too much liquidity. So BBSW, which is the bank bill swap rate, which is the rate banks lend to each other on, is at zero, right? They cannot get money any cheaper than they're getting it right now. It's as simple as that. So that is also having an impact, because when you have too much money and you're getting it cheaper than you ever had, the last thing you want is that money just sitting on your balance sheet doing nothing.
And so what are they doing with it?
Well, you're going to want to try to lend it within reason. You're going to want to try to lend it, right? Or you're going to give it back. You're going to price yourself out so people can just take their money back. You're not, BBSW is at zero because you don't want the other bank's problem, right? So everyone's saying, no, you keep your money and do something with it. There's a real onus right now to lend. They want to lend. They want to do as much from a money good lending perspective as they can. That's
really insightful, because bank lending in Australia is a massive driver of property prices, as you would know. And if banks are continuing to push money and lend money out and saying, go do something with it, what are most people doing with it? They're buying property. Are they investing in businesses? I don't know. I don't know the data in front of me.
It's Australia.
So they're investing in property.
Yeah.
And we're seeing clearance rates up in the high 70s, 80%, I think, only a few weeks ago. And we're seeing record prices. We're seeing really low vacancy rates. Rents are rising, and it's the polar opposite to what was going on last year. And is that driven by what you've just explained, Andrew?
Yeah, I think low rates helps, right? Because a lot of Australians live off their P&L. They look at their profit and loss statement, they look at their headroom, and they go and borrow. So look, there's no macro prudential action at the moment. APRA are not sitting there limiting the level of activity. And look, in fairness, we've come off a period of time where property prices weren't strong. You know, you went out of the election there. You came out of the election in 18, 19, that period there, where there was all this talk around negative gearing ending, and the property market was really, really soft for a period of time, right? And then as it began to recover into late 2019, early 2020, we had the bushfires, which knocked confidence around a little bit, and then we had COVID. You know, so it's not like the property market had been running away from us. We had the, all the new serviceability criteria had already come in, which had really, everyone had the anecdotal, examples of their Netflix bill stopping them from being approved. And at the same time, you previously had APRA really knuckled down on IO and investor lending as well. So it's not like you'd come out of a period of supernormal growth and now we're growing from that very high level. Essentially, we've had a flat market for a couple of years. We've had a 2020 where people's savings rates have skyrocketed. You've got money that is being sold really, really cheaply. You've got people buying the RBA story that they are fine, that rates aren't. We're not going to surprise you here. We're not going to come at you from another angle. You can trust the rates where they are. And people bring all of that together and they make decisions to purchase property. It's completely reasonable. Right. So, and if that if that can coincide with I don't think the risk that's being written is bad risk, but if banks can actually get back to the business of lending money and being a bit more proactive in that regard, I think all of that's a positive. And, I don't think the central bank at this stage, the Reserve Bank or APRA for that matter, would be looking at the increase in property prices as being a red flag right now. If this continues on and you see property prices move into the end of the year and they've continued their cadence and we're starting to see an increase in more speculative forms of lending like interest only and investor lending, if that starts to become the case, well, then at some stage, there is a question of what do you do about it? But what we've seen, not only here in Australia, but globally, when those numbers start to become problematic, what's become the favoured tool of choice is macro-prudential regulation, which means you put caps on things like investor lending or interest-only lending. You do something around loan-to-value ratios, and don't forget there are new capital rules coming in that will affect the banks in terms of the underlying risk, that will look at things like loan-to-value ratios, that will look at things like interest-only and investor lending. So these factors are coming in as well, where the return on invested capital on a safer loan will be higher for a bank than a more speculative loan, right? So these plumbing factors are going to come in and they're going to drive a greater differential of pricing between loan product as well. And you can already kind of see that, right? Like you've got
how much impact is that going to have though when you talk about loan-to-value ratios, when you've got the valuation component of that formula having increased significantly. So these loan-to-value ratios are actually looking pretty good because valuations have increased and the loan, an existing loan has not increased, but the value's up 10, 15, 20%.
If you're an existing holder, that's just the reality, right? If you're a new buyer, which is probably what we're talking about now, where you're buying at that extended valuation at a higher LVR, what does it mean? Well, what it means is traditionally here in Australia, we've had a system that subsidises itself from the perspective that your super prime borrower, that's at an LVR of 60, 65%, couple, both PAYG, neither of them self-employed, none of them have had a credit event in their life, live in a nice suburb in Metro Melbourne in a fully detached home, or maybe not Metro Melbourne in 2021. That would have been prime once upon a time. It still is, actually.
Down the peninsula.
Down the peninsula. So that person probably overpaid for money. And, the person who was an owner-builder that had 4 properties on interest only, the property speculator, that person was probably getting a rate that was too low. Right. So this is, and the fact of the matter was there wasn't enough distinction in terms of the capital rules of one versus the other. But now that actually develops and forms, what you're starting to see is the emergence of certain non-bank lenders that are going after that super prime market, right? That, groups like Athena, I don't know if you've heard of those guys, or Nano, for example. So, now what you've got is a distinguishable cohort which will have its own pricing. And that cohort will have its own pricing because the capital required to write that loan will be lower than the capital required to write a more speculative
Makes
loan.
sense.
Now, what you need to understand about our banks is all they care about is the return on invested capital. If I were to be cynical, I'd say that's because the short-term incentives of the management team generally are focused on ROE, or a good component of these short-term incentives are focused on ROE. So even though the net interest margin of some of these safer assets might be lower, the return on equity is really attractive. So what you have is the books the books of the major banks, they're being pivoted towards this lower risk type profile. So, it's been in the papers. I think that that Citibank are looking to sell their cards business, for example, which is a big deal. It's like, I think they're the 5th biggest cards business here in Australia. There's been some talk that I think Westpac have put their auto book on the block, for example. That's been reported in the papers. It's a pretty traditional banking type product, right, to be walking away from. Why? Well, you want a simpler business. You want to walk away from having to deal with the customer at the front end, which is retail type business, and you want to be able to gravitate towards higher quality type risk. So again, that, getting back to the earlier point, that is going to protect the system to some degree, because you're going to see that speculation will get more expensive, and then if it gets out of hand, APRA have the ability to put an even higher capital impost on certain kinds of loans, where the banks then they will just, as soon as you make them hold more capital against something, it is complete mind control. You will get them to do exactly what you want them to do. It's a really effective measure. And then you don't have to touch rates. You can leave rates lower because you manage the supply-demand dynamics around property, and you stop it from becoming a bubble that way, okay? Because essentially you're not going to want to torch whole cohorts within society. So, for example, recent home buyers that have an average, mortgage of 500 to 700,000 that are in their late 20s and early 30s. You want these guys being able to, you want these families, these individuals, you want them being able to engage in household formation. You want them to be able to invest in themselves, their families. You want them to, because these are the guys that drive the economy at the end of the day. With a society like Australia, where you have demographics that are we're starting to age over here as well. You're not getting pensioners to spend more, right? It doesn't matter how good the outlook is, because zero rates, funnily enough, what that does is it motivates you to just want to save more, right? So, that's deflationary as well. That's something that often gets missed when you're looking at, grandma's not buying little Timmy whatever he wants when they go to the supermarket, when they go to the local shopping centre now, because, essentially you could have, I think we mentioned it last time, you'd have 10 million bucks and you've got a special TD rate from some bank you've never heard of right now. It's between 30 and 50 basis points. Imagine only, this is the whole thing. Imagine pulling 50 grand a year out of money that's not at risk there in a bank at 10 million, 50 grand. The pensioner couple, what does a pensioner couple pull out these days? Is it in the low 30s?
Don't know.
30 odd thousand? You're better off just putting it all in an owner-occupied residence and living off the pension. That's not advice, by the way. It's probably a really bad idea.
That's okay. We get the disclaimers.
Yeah, it's probably a really bad idea. But it just sort of shows you
if that's the case, right?
Yeah.
Those levers that you were talking about before that enables regulators to have a greater level of control than simply having a blunt instrument like interest rates, which is trying to throw an entire blanket over the entire market.
Yeah.
Are those subsectors, so investor only, investor loans, interest only, are they a problem now, or is all of this being done to ensure they're on the front foot, that if and when that becomes a problem, we've got the tools to be able to manage them in a way that doesn't absolutely kill the entire market?
Yeah, no, spot on. They're not a problem. And yes, it puts us in a position where it can be controlled. So APRA have done a pretty reasonable job in terms of how they've put this together, outside of the fact that many people would say that perhaps they were heavy-handed and went further than they needed to in the first instance, which put a bit of a hole into some of those investor and interest-only markets. But look, no, personally, I think as a firm at the moment, we don't have a concern around where property markets are in terms of volume of transactions, in terms of the types of loans written, in terms of how the performance of property. We feel that it's probably got a bit further to run. But equally, if it were to continue on and if it starts to flash red, so to speak, well, then there's another question. And the other thing is, where do wages go? Because if we do actually experience wage growth in the economy, if we can get there, if we can get to 3.5% or whatever the RBA is projecting for 23-24, well, then, property prices increasing isn't necessarily a problem either. I mean, at that stage, it's logical. You'd expect it. The fact, though, is in the shorter term, the growth we've seen would outstrip any normal notion.
Is it that we need wage growth, Andrew, to be able to sustain all of these things that we're talking about?
Yeah.
We need wage growth, right, to stabilize and act as the foundation for everything that we've just talked about.
Yep. Yeah. Look, I mean, at the end of the day, every year we compare this year's numbers with last year's numbers. So there's this notion that everything gets bigger, gets faster, grows, right? And that's just as, at the same time that, technology is making you need less hands. There are less people around anyway, and we're all getting older, and, your predisposition to consume as you get older is a lot smaller than it is when you're younger. And when you're young and you've got very large amounts of debt, you're not necessarily in a position to consume. So there are all these factors that by their very inherent nature are deflationary. In essence, life is deflationary. Like you want less, you need less the older you get, until you eventually need nothing, right? But a plot of dirt, that's just its very nature. So
well, I think you still own that plot of dirt even after you're gone, don't you?
It depends on how deep they put you, Rob, under a certain level that belongs to the government. So
with all that stuff we've talked about, you're managing billions of dollars of money, and we talk about property. That's a big component, because that's a big component of the banks.
Yep.
You invest in banks. It has a very, very much a domino effect on everything that we are talking about and what it is that you do.
Mm-hmm.
Pull out the crystal ball. What is going on? What if we look into the horizon? What is happening in the market? What is happening with the banks? Are things all okay? And by definition, by risk's definition, we're not going to see the thing that comes and punches us in the face, right? That is the pure definition of risk. But going back to what you were talking about earlier, by having these range of probabilities or range of outcomes and applying probabilities to them, what's going through your mind? What do you see as how this unfolds? But also the biggest thing I'm really curious about is when you go to bed, do you ever think about, shit, if that one thing happened, that's the biggest worry that I have. And you almost turn a blind eye to it because you don't want to face it. You don't want to look at it and think about it. So look in the crystal ball, and then tell me after that, what is the biggest risk you see, the thing that you're most worried about?
That last one got a bit heavy, Rob, but we'll leave that one to the side. Look, in terms of fears, we'll just cover that one off. And look, I think at the end of the day, you get old enough, you see enough stuff, and where you get to is that there are more important things than this stuff at the end of the day. And as long as, the only thing that would make me lose sleep are those that are closest to me being, I just want them safe and healthy. But putting that aside for a moment, from a market and business standpoint, look, this business is a substantial asset for myself, as it is for Rob Camilleri and for Ken Liao, my partners. And we've got another 11, 12, 13 guys over here as well that are relying on us. So your inability to provide for them is always the thing that sort of looms in the back of your mind. From that perspective, what worries you is an environment where you're not necessary. So if you're in a Japanization where high yield pays 0.1 over investment grade, do you need to exist, and what can you charge? The first question, the first answer is no, and the second one is nothing. So that's existential, right? So the reality is that an environment where funding rates just go to zero, and there's too much liquidity around, and there's no ability to really add value as a fund manager or as an investment manager, look, that's the one thing you don't recover from. That's death, right? For us, that's death for our business model. That's death for a good portion.
Is that a real risk?
I mean, look, it's one risk that's out there.
Mm-hmm.
It's not impossible. It's probably not, it's probably implausible, but it's certainly not impossible. I mean, if you take a view that deflation is a fait accompli and rates go negative and blah, 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 well, then, that's something you arguably face. Then you've got to adapt and you've got to evolve. And look, that's that's where look, I think, we were investing heavily in areas like RMBS and ABS back in, 2011, 2012, when it was an anathema. No one wanted to hear the acronym. The Bank of International Settlements were telling you that it might not exist. You had movies all over the place telling you that, it's terrible. And, we get to today, and I look around at a lot of our competitors now, and they've got, 30 to 50% of their allocations in RMBS and ABS, over, I think 2 or 3 years ago, we started to move into the wholesale funding markets, so into the loan facility markets, where we fund non-banks and regional banks. And the reason we did that again was the fact that you look at a potential future reality where rates are so low that you're going to have to be a little bit different. You're going to have an edge. You're going to have to go about the problem of delivering returns a little bit differently. So yes, it's that's probably the thing that sort of loomed larger, but like equally, I would say that we've done our best to mitigate that risk. Okay, and actually, it's our objective to remain relevant, where we've got the ability to deliver utility as a provider of a service of funds management. But if rates get really, really low and they stay there for a very, very long time, the ability to do that becomes a lot more difficult.
Sure.
Okay. So that's one thing. In terms of the risks and bad things happening and things selling off and whatever else, like, look, a little bit of chaos is great. We're a contrarian investor. We like to trade. We like to dip the shoulder in and go a bit harder when things become a little bit discombobulated. That's our jam. That's our thing. So I'd be a lot less concerned about bad stuff sort of happening from that perspective than I would in a scenario where nothing bad ever happens again, because things are perfectly controlled, which I don't think is going to be the case. Again, I would say it's implausible, but nothing's impossible. In terms of the banks, look, it's not the risk you think it is. For the banks, the bigger risk is what happens with their business models, right? So right now, selling money is great because your funding costs are at next to nothing, right? Yeah. Your provisioning losses your provisioning is being written back, so you're not going to lose money from underperformance. Okay. So look, the reality is that it's not a bad time to be a bank today. But you look forward, and there are a lot of challenges, a lot of really, really significant challenges for the industry, and the crystal ball isn't necessary. You can see how, you can see what Bank of Tokyo Mitsubishi needs to do to make money. You can see what JP Morgan needs to do to make money. You can see what BNP needs to make money, what Toronto Dominion Bank does to make money. And what I mean by that is these banks operate in really low rate environments where they're dealing with a lot of the problems that we didn't think would come to us, right? Like this really low zero environment. For a long time, we thought that was just something happening over there. But now that it's over here, you can see what those businesses have pivoted to. You can see what they look like. Okay, and what they look like, they have a much smaller component of their earnings coming from lending. They have a much larger component of their earnings coming from trading and transactional type income. And not transactional income in the Australian sense, where for want of a better term, you're clubbing baby seals over the head and using credit card fees and mortgage fees and this fee and that fee. We're talking about needing to run more active trading books. We're talking about asset management. We're talking about thinking outside the square and earning money harder. Okay, so
but they're precisely the things that the banks are getting out of.
Exactly.
And I think we talked about this last time.
Exactly. So Macquarie,
it's merry-go-round of
so they're going to sell. Absolutely. So they're going to sell asset management books, because the return on invested capital on the asset management book is 8 to 10%, and their mortgage back book gives them 15%. But there will come a time, or the mortgage back book doesn't actually gives them 15%. But this is the thing. So here's an interesting idea of a back book versus a front book. So the return on equity a bank makes when you walk through the door is a lot lower than the return on equity it makes after you've been there for a while and you've gotten rusted on. So that's the back book. Back book's really profitable. The front book tends to be a bit more marginal. But your mortgage book still gives you returns on invested capital in the high teens. So when you compare that, with an asset management business, you sort of sit there, well, you go, well, that asset management business is dilutive and it's chewing up a lot of capital, and I could take that capital back and I could lend more with it. But then you get to the point where it's really hard to lend at a level that's in line with system. It starts to get really hard to deploy money. And what happens is your front book and back book, they start to equalize. And why is that going to happen? Well, open banking is a reality in places like the UK. That I think Athena are an interesting business in that they're sort of saying we're going to reprice the back book and the front book. We've got one price, and even if our price isn't the sharpest at the front end, we will reprice it back here. Now, cynics would say that's something that's really easy to do when you don't have a big back book. It's very easy to be charitable when you've got nothing in your pocket. But, if there is certainly an opportunity to disrupt the returns on the back book basis that type of activity. So then core banking becomes, core banking, which, the mother dough, the mortgage book potentially becomes a lot less profitable than it is today. And then you're going to regret that you've sold that other business, and even wealth, getting rid of wealth. Might have been short-sighted. I mean, after we go through a process where everyone's done the face here and they've put you guys through the ringer, and you've finally, and you've brought robo advice in, so the ability to build efficiencies into the advice model is there. A lot of that would actually speak to thinking that maybe I should increase exposure, not that I should decrease it, right? So I wouldn't be surprised if you see them come back into that market again at some stage. It's a natural, I think to some degree, it sits naturally with the rest of banking. Wealth always has, but look, nonetheless, again, after ROEs get there, you're going to look at that and think, cheapers, it might have been a good idea to hold on to that. I mean, JP Morgan are heavily invested into their asset management book, right? Like they're actively pushing clients with deposits right now into mutual funds because they've got too much liquidity. And they're not pushing it into someone else's mutual funds; they're pushing it into JP Morgan mutual funds. Right. So that's right. So this is the threat to banking is that it gets harder to make supernormal returns off really simple product, and disruption is coming. And more to the point, the fact is that the cost to income ratios of a lot of these guys that will come in might be lower because they use technology better. Everything's already in the cloud. They don't have to run cost to income. And our bank cost to income ratios, mind you, are very, very competitive. Okay, in the low 40s is not too bad. But for the fact that American banks and Japanese banks and European banks have to work a lot harder for their money. So they will pay traders and asset managers, and they will trade. And these types of businesses historically have higher expense bases, right? So when you contrast it against the simplicity of Australian banking, they're probably not as low as they look. Moving beyond that, though, you've got regional banks that have cost to income ratios, and small mutuals, for example, that have cost to income ratios of 60% and up. So, the need to invest in technology for these guys, the need to actually right-size themselves and streamline themselves is, for some parts of the Australian banking market, existential. You can't be paying 60 to 70% away. You can do it right now that BBSW is at zero and net interest margins are up to where they are, but that's not sustainable. So look, the challenges to banking beyond the here or now, they're significant. And that's why when you hear Matty Common coming out and saying we're a platform, where we've got the data, which they do, and it's super valuable, right? Like the data they do hold is really, really valuable. Yeah. So the ability to actually create a platform, an environment, a marketplace, and it's interesting. And the fact that CBA articulate the conceptualization of their organization from that perspective is interesting. It's interesting the way they're choosing to curate their sound bites now, right? Because that might be giving you a little bit of a hint in terms of where they're headed. Look, there are some challenges ahead, but I think the concerns everyone had late last year, they're not really concerns. I think arrears are fine, net interest margin's good right now, but where you've got to have your eye on is what disruption looks like for banking.
I think you're absolutely right. The complexity of all of this is just so detailed, the intricacies, the components that make up what it is that we try and distill into reading in a newspaper or anything like that. You just can't do it. There's quite a few things that I've taken out of today. Discombobulous is a new word I think I've learned.
Discombobulated. I picked that up last year as well. I really liked it. So, I thought I'll put that one into the lexicon there. It's got a bit of a flow to it. Thanks.
I
Rob.
like it.
Yours,
but
mate.
Andrew, maybe we're going to have to do this again in 6 months to see where things landed. But I do agree with you that nobody does have the crystal ball. Even if you don't need the crystal ball, the reality is that there's many outcomes that can eventuate. And the question is, how do you put probabilities on each of those? And asking the question about, well, what if I am wrong? What does this actually mean? And how to manage risk. I think a lot of people have been taking on, for all the reasons that you've just talked about, have been taking on excess risk beyond what they would have ordinarily done. And it's that imaginary hand forcing people to do things they may not have otherwise done. And for now, the music keeps playing and we'll all keep dancing. And but the music will stop one day. And it's about risk management and how you position yourself so that when the music does stop, you do have a chair to sit on. Might wrap up, Andrew. I appreciate your time. Good to see you. We'll chat again.
Thanks.